The house of cards was much bigger.
$152 billion this year.
Buy up to $700 billion.
Obama signed the $787 billion economic stimulus.
Congress approving another $484 billion.
Approximately $2 trillion package.
President Biden is set to sign his landmark $1.9 trillion COVID relief bill.
Like, look, if you and I go out there and keep raising debt, okay, we keep getting credit cards, and we get more credit cards. And more credit. That's what America's doing.
We've been doing it for years.
Yeah, but at this level, but how come a massive, ridiculous crash hasn't yet hit?
Between the year 2000 and 2021, the US national debt has grown 390%, from 5.7 trillion to 28 trillion. The broad money supply has grown by 300%, from 5 trillion to 20 trillion. In the same period, the GDP has only grown 109%. In 2020 alone, the national debt has grown by 20%, the money supply has grown by 33%, and the GDP grew by roughly 0%. Simple logic would tell you that more money printing with much less production means inflation, but the inflation rate in the US for 2020 was only 1.4%. And according to official numbers, the inflation rate has somehow remained at around a very healthy 2% for this entire period of massive printing. So how is it that over the course of 20 years, the national debt can rise 390%, the money supply can rise 300%, while the GDP only rises 109%, and yet the inflation rate is still around just 2% per year? There is a very negative stigma surrounding the printing of money, otherwise known as quantitative easing. Because truly unrestrained quantitative easing has the capacity to completely shut down a nation's economy and wipe out the wages and savings of hundreds of millions of people. But in the rest of this video, we will explain how quantitative easing can be done without causing excessive inflation, and how it was absolutely crucial in preventing the total collapse of the US and the world's economy in both 2008 and 2020. This is a complicated topic, so in order to answer this question properly, we need to explore one of the greatest periods of economic distress in all of history, the Great Depression. On the 3rd of September 1929, the Dow Jones peaked at 381. On the 28th of October, the Dow Jones dropped 13%, from 299 to 260. On the 29th of October, the Dow Jones dropped another 12%, from 260 to 230. The Dow Jones is now down a total of 40% from its all-time high in September, and despite attempts by market leaders such as William Durant and the Rockefeller family to instill confidence back into the market, it continued to drop. By November the 13th, the Dow Jones had dropped all the way down to 199, a total drop of 48% from its highest point. Over the next few years, the Dow Jones continued to drop, and disastrous monetary policies led to the Great Depression. The government introduced import tariffs of 20% in order to protect domestic businesses. But countries around the world responded with their own tariffs, and this caused global trade to plummet by 65%. During this time, the US dollar was backed by gold at a fixed rate of $35 per ounce. In 1907, a similar event occurred, where the New York Stock Exchange crashed by almost 50%. The ensuing panic led the masses to withdraw their money, exchanging it for gold, and this caused numerous banks to enter bankruptcy. So people started doing the same thing in 1929, trading in their dollars for gold in droves. The Federal Reserve feared that their gold reserves could be drained, and that a repeat of 1907 would destroy the economy once again. So they raised interest rates up to 15.92% in 1932. This meant that if you kept your money in the bank, then the bank would pay you 15.92% of that money a year for not taking the money out. But this also meant that businesses taking out loans would have to pay the bank at least 15.92% a year until the loan was paid off. Since high interest rates were causing people to hold on to their money, the prices of goods and services declined, and this led to massive deflation. The prices of goods and services decreased by almost 11% in 1931. Consumption grinded to a halt. Entrepreneurs could not get loans to finance new businesses. Wages decreased and unemployment increased. On July 8, 1932, the Dow Jones bottomed out at 41.22, a total of 89% from its highest point. By 1933, the GDP fell by almost 50%. Over 4,000 banks and lenders failed. Tens of thousands of businesses closed down and unemployment hit 24.9%. Hyperinflation is bad, but hyperdeflation is far worse. In 1939, World War II broke out. To fund the war, the government finally decided that it would take on a serious amount of debt. The government takes on debt by issuing bonds, which at the time were purchased mostly by citizens and repaid to them with interest. Out of a sense of patriotic duty, the bonds were purchased en masse. People stopped hoarding their cash, and this spurred economic production and consumption. In 1941, for the first time since 1929, the unemployment rate dipped below 10%, and the Dow Jones rose 40% during the war. A lot of lessons were learnt as part of the Great Depression. Germany had just gone through crippling hyperinflation in 1923, which was caused by excessive debt and printing. This led the US to taking an overly conservative approach to spending. Import tariffs, high interest rates, massive deflation, and a reluctance to take on debt all exacerbated the depression. It easily took more than 10 years for inflation, the stock market, and unemployment to recover. All of the lessons learnt from the Great Depression were applied during the global financial crisis of 2008 and the COVID-19 crisis. So let's talk about how in both of these cases, the recovery times were far shorter than that of the Great Depression. Hey guys, just a reminder, if you've enjoyed this video so far, please like and subscribe to support us. We're just two people and we spend a pretty crazy amount of late nights researching, recording, editing, and animating these videos. But we believe that the creative delivery of ideas and information is an important and a necessary art form. So please like and subscribe to support us. The 2008 global financial crisis. In 2007, the number of real estate foreclosures grew by 75%, from roughly 1.3 million to 2.2 million. A very serious crisis in the subprime mortgage market was emerging. In January of 2008, the Fed tried lowering interest rates in an attempt to save the market, but it was already too late. On the 11th of March, the Fed lent out $200 billion to bond dealers. On the 14th, they guaranteed $10 trillion worth of bad loans held by Bear Stearns. On the 18th, they purchased $200 billion worth of loans from Fannie Mae and Freddie Mac. On the 11th of July, IndyMac Bank fails. The Fed continues issuing loans, grants, term auctions, and tax breaks to try and keep the market afloat. In August, Lehman Brothers were on the verge of bankruptcy and needed to find a buyer. Being an investment bank, the US Treasury had no legal authority to bail them out, and Lehman Brothers did not have enough assets to secure a federally backed loan. Negotiations with buyers broke down, and on the 15th of September, Lehman Brothers declared bankruptcy, wiping away over $600 billion worth of assets with it. Over the next 3 weeks, the market crashes from 10,917 to 8,451. Banks such as AIG, Merrill Lynch, and WaMu either fail or are forced to sell. On the 3rd of October, Congress signs a $700 billion bill to bail out the banks. On the 7th, Congress signs a $1.7 trillion loan program to support businesses. On the 21st, Congress signs a $540 billion bailout for money market funds. And by the 29th of December, interest rates hit a record low of 0.08%. The Dow Jones continues to plummet, going as low as 6,547 in March of 2009. The response to the GFC was almost the complete opposite of the response to the Great Depression. In the 1930s, the Fed raised interest rates to 15.92%, did hardly any printing, and the government took on very little debt. In 2008, the Fed lowered interest rates to 0.08%, and the government guaranteed trillions of dollars worth of loans, bailouts, and business support. Now, if you look at the Dow Jones in the first 3 months of the Great Depression compared to the first 3 months of the GFC, they aren't very different. But in the case of the Great Depression, it took the Dow Jones 22 years to recover, and the unemployment rate took 12 years. In the case of the GFC, the Dow Jones recovered in less than 2 years. The unemployment rate took 6 years to recover, and it peaked at only 9.6% instead of 24.9%. And despite massive government spending, the inflation rate was only a little higher than usual. Massive money printing is very bad. Too little money printing is very, very bad. But moderate money printing is good. But where is the inflation? Shouldn't there be consequences? How much printing is too much? Who's going to pay for all of this debt? Are we just pushing the problem off to a later generation? Let's answer some of these questions in the next section. The COVID-19 crisis. In March of 2020, the economies of the world locked down. Unemployment in the US skyrocketed from 2.5% to 14.8%, and the stock market took a 30% nosedive. The Dow Jones went from 29,187 to 18,401. The US government issued record-breaking emergency relief. National debt grew 17% from 23.69 trillion in March to 27.75 trillion in December. And the broad money supply grew 25% from 15.75 trillion to 19.7 trillion. But despite a flood of money into the economy, consumer spending fell by 6% and inflation was only 1.4%, which is almost half the inflation of the previous year. But how can inflation possibly be lower than last year? To understand this, we should look at the stock market. In 2020, between the 12th of February and the 23rd of March, the Dow Jones crashed more than a whopping 30%. A stimulus bill was introduced. It included up to $1,200 of direct payments to individuals, $425 billion of direct bailouts of businesses, $377 billion worth of federally guaranteed loans, and $500 billion went into government lending programs. Companies that received bailouts were barred from performing stock buybacks. A stock buyback is where a company purchases its own stock back from the market. This increases the price of the stock and makes the stock more financially attractive. Companies that were now confident that they could secure loans from the government were able to use their cash reserves to buy back stocks at a massively discounted price before the government barred them from doing so. In the quarter ending with March 31st, Visa buybacks increased by 30%, Microsoft by 37%, Google by 40%, Amazon by 355%, Johnson & Johnson by 400%. This very sharp uptick in the market both prevented the market from falling further and encouraged other investors to put their money back into the market. The price of the stock market is not actually a reflection of the economy. It is more accurately a reflection of the confidence in the future of the economy. So with the majority of big and medium enterprises secured by federal action, the market fully recovered and hit a new all-time high in November the 24th, only 8 months after the crash in March. The total value of all US stock markets grew by a whopping 34% in 2020, from $37.7 trillion to $50.8 trillion. The velocity of money fell by 22% in 2020, meaning that money is not moving around very fast. Inflation is hardly occurring because a very large amount of the new money isn't being used by people in day-to-day transactions. It is simply being used to maintain the value of the stock market. Inflation occurs when the prices of goods and services increases, but if most of the new money remains stationed in the stock market, then it won't be able to affect the prices of goods and services. It only affects the prices of stocks. Markets and economies naturally fluctuate, going up and down. Steep rises are usually followed by sharp falls, which often create economic chaos. And it seems that since the GFC, governments are becoming adept at leveraging debt in order to flatten out the sharp falls and restore order. So, will this cause hyperinflation in the future? Let's look at a simplified example. Suppose apples cost $3, then for some reason, a very rich man takes money out of the stock market and he uses it to buy a load of apples. The supply of apples will decrease and there will be a lot more money in the economy, so the price of apples will go up. Let's say apples are worth $3.30 now. That's 10% inflation. way too much. To normalize inflation without government intervention, the economy needs to make apples more efficiently. So maybe an apple production company hires more staff, designs better systems, and creates innovations, and it's enough to reduce the price of apples down to $3.06, which is only 2% inflation. So now it's perfect. But we can't have inflation fluctuating from 10% to 2% like that. So the Fed needs to control the flow of money to match the pace of production. If money is taken out of the stock market at a faster rate than the economy is able to increase production, then inflation will occur. So the government will need to inject money back into the stock market in order to entice investors to reinvest what they're taking out. It is very counterintuitive, but it's actually far more dangerous for the government to print too little money than for it to print too much money. Since the US stock market is worth $50 trillion, a 10% drop would cause $5 trillion to instantly flow into the economy of goods and services. And if this money was allowed to affect the prices of goods and services, then it would be catastrophic. If the government prints irresponsibly, then one day, the stock market could become so gigantic compared to the economy of goods and services that even a 1% drop could cause hyperinflation. Then, we will be in serious trouble. But hopefully, that day never comes. And this is why the US can print trillions of dollars without causing inflation. Not necessarily because they want to, but because they have to. Hey guys, thanks for watching. This model of storing huge amounts of dollars in the stock market is likely the most significant cause of inequality in the US. But that's a story for another video. So don't forget to like and subscribe. We're a new channel, so if you like this video and want to see more stuff like this, please like and subscribe.